Okay, welcome to the financial projections part of Nuts and Bolts tonight. You heard in the financing sources panel that you have to figure out what the resources you're going to need, financial resources. And one way to do that, or probably the only way to do that, is really have an idea of the financial health of your business, of how do you figure out what you need, when you need it, what it'll cost, and how does that all flow through into projections. And to do that, tonight we have Steve Derezinski, who's from the panel, so that's a nice segue. And he tells me he's a parallel entrepreneur. I'm going to let him describe that. And good. And you'll also talk about your SBIR program?
I'm going to plug the SBIR program too, for sure.
Excellent.
All right. Thank you, guys. I didn't think that 7:30 on a Wednesday night we would talk about building financial projections and you guys would still be here and riveted. So the spreadsheets that generate these have been posted on the website. So I recommend you pull those down if you haven't already. There's two spreadsheets. One is the financial projections template, and the other one is an equity distribution plan template. And that's what we're going to go over in this talk. So this talk is borrowed from Charlie Tillett, class of 91, and converted by Joe, and now converted by me. So building financial projections is clearly a fun topic. Just before we get started, I am a parallel entrepreneur, which means right now I'm doing a bunch of startups at the same time, primarily because if you get into the investment world and you understand portfolio theory, you want to have multiple shots on goal at the same time. So now I'm starting a lot of different companies in what I call a co-foundry. So I'm founder of the Kendall Square Co-Foundry. Okay, in terms of my financial background, I mentioned I'm an engineer by schooling, course 2 here, but I also have an MBA. And I've also started a bunch of companies and raised a whole bunch of equity-based capital. So if you ask me a financial question, you're probably going to get an engineering answer first. And I should know all the financial words around all the stuff, but more than likely you're going to get kind of a scientific, nerdy answer to the question. And that actually reminds me of when I was first launching my first venture, I actually had a CPA as a co-founder. And I remember talking to him about creating our financials and creating our financial projections. And I kept arguing with him about, why do you put this dollar value in that column and not over here? And who decides this stuff? And I was getting really frustrated because in the world of kind of financials, there's math, right? There's like hardcore math that defines the rules. But when you get into accounting, it's an accounting science. So my friend who was a CPA had his degree in accounting science, and he finally explained it. He explained it to an engineer, which I will explain to you now, which is, he said, look, Steve, it's an accounting is a science, but it's a man-made science. So the ultimate ground truth for me as an engineer was always the laws of nature, right? You can't fool the laws of nature. You try and engineer some things around it, but that's ultimately the ground truth of what I'm trying to find. In accounting, the ultimate ground truth is a bunch of people that came up with rules and things and policies. So as soon as I realized that, I'm like, okay, so I don't understand why this number is in this column, but you're telling me there's some generally accepted accounting principles, and that's the reason why. So if you get frustrated in all this stuff, understand that this is just the way it is, and that's how it shall be. So, okay, but let's get into it. This is what we're going to talk about: building a business plan, financials for the VCs, for the 100K judges. What is a business model? We heard a little bit about that on the last panel. Building your financial projections, and then sharing the pie. Also, these slides, hopefully Joe will be able to share them with you, so you can access them right now. They're on Google. They're on a shareable Google Drive. So we're going to get into some. Oh, the link is live. Where did you post it? Oh, on the website? Wow. Webmaster Joe right there. All right. And then the last item we're going to talk about is sharing the pie. So you guys are all faced with kind of, I have this new company. It has an equity structure. How do I decide who gets what amount of what? And that's the second topic. Okay. So I know what you're all thinking. It's exactly what I was always thinking. I'm too busy to do financials. It is going to be wrong. And that's true, actually. It is going to be wrong. VCs don't believe them anyway. They're always pushing back and asking me hard questions. I have important things to do. I've got to build my product. I've got to figure out the technology. I've got customers to talk to. I've got a team to build. That's all true, right? Those are all important things. Here's why. Because building a financial projection really tells you what your oxygen level is, and cash is really the oxygen of your business. And financials are a way to measure that and make sure you're on board with that. And it's also a roadmap to determine what kind of cash you're going to need for your business, which is what we're talking about in the last panel. And a vehicle to obtain the cash, but really a method of communication to the rest of the investment public around what is the potential of your business. So in the beginning, I said we're talking about building financial projections. That means you're predicting the future. So of course they're going to be wrong, because nobody can predict the future perfectly. But what investors and what judges want to know is, you're the one closest to your business. What does this business look like financially? Like, how does it grow, and how does it, where are the levers on this stuff, and what assumptions did you make when you grew these things? Those are all important points of conversation between you and future investors, to so they have a full understanding of not just kind of like the cool technology that's going to do something fun, but really financially, like, how big can this be and what kind of margins can you make? Okay. So that helps them understand your business, assumptions, drivers, milestones, and exposures and risks. Failure to plan is planning to fail. Now I sound like a general or something, sergeant. So your job as startup CEO is to maintain the oxygen supply. We'll talk about accounting terms here. I assume, do we have any accountants or bookkeepers in here? Anybody with a finance background? No? Everybody's looking at their toes. Hey, all right. Bookkeeping, accounting, what? Oh, so you know, why don't you come up here and teach this? Okay. So like on the accounting side of things, we're going to talk about the standard way that set of accounting books are created. But in terms of like drilling down into your business, average selling price isn't necessarily something that is found in a standard financial sheet. You can put it on there, but it's not really a standard term. Gross margins are, cost of R&D, and the rest of these are. So you want to understand these, because this get at the root of the financial health of your business. Of course, we did talk a little bit about VCs in the last talk, but this spells it out explicitly. They want 3 to 5x absolute return of their portfolio. So that means when they talk to you, they know there's a risk in investment, and they probably want to see a 10x return from your pitch. And it has to be a believable 10x return, because they know they're going to have some oopses in their overall portfolio. So their overall portfolio is going to be 3 to 5x. So that's what they want. And as Julianne said, they have a 5 to 7 year horizon, and a 4x in 5 years is an IRR, which stands for internal rate of return, which is just an Excel spreadsheet equals IRR, and you can figure out how to actually do the calculation on that. I tried to give you a simple example of it's sort of the slope of the growth curve. So the higher the IRR, the higher the slope. You can tell I'm a mechanical engineer because I like graphs. Okay. What is it that they want? They want to get a significant amount of money invested, at least $5 to $10 million, and own a significant percentage. Typically in the early stages, it's under 50%. And I'm sure you'll get 20 different opinions about this, but in my view, or in my experience, the earliest stage, they don't really want to tip over the 50% level, because if they do, then that means they're the owner of the business and they take control of the business. So early on, it's like, hey, we want to get these founders to do all the technology work. So you'll see some things. I have some examples in here you'll see. And if you're not familiar with the phrases pre-money valuation and post-money valuation, it's actually a really simple formula, which is this. I mean, the VC percentage is the amount invested divided by the pre-money valuation plus the amount invested. And the post, so it's kind of funny because, it's like, what's the difference between pre-money and post-money? Well, it's the amount of money the investor put into it. So if you have a business and you say it's worth $4 million and the investors put $1 million in, well, now you have another $1 million on your asset on your balance sheet. So now your company is worth $5 million. So the post-money investment is just simply that. And I know that the words can like, what's your valuation? And it's like, do you mean pre-money or post-money? Like, how much are you raising and what's your valuation? So this is the simple formula that is behind all those things. If you don't know it, now you do. So, okay. So here's an example of what VCs want. So let's say in Series A, they invest $5 million at a $5 million pre, that's 50%. These data are from 2018, by the way, so may have changed a little bit. And then in a Series C, they invest another $10 million at a $15 million pre-money. So in this example, in the Series A, the 5 million invested 5 million, what's the post-money valuation of that business? 10 million, excellent, everybody can add. So it was 10 million. So between Series A and Series B, it is now 15 million. So what happened between Series A and Series B is that the business did some work and added more value. So now they're worth $15 million. And then they raised $10 million on a $15 million valuation. Yes, Maine.
Question, how do you actually, I know it's pretty, how do you calculate valuation? $5 million pre-money valuation.
Yes, good question. Yes, okay. So I walk into a VC, I have a great idea, I've got a bunch of patents, I got a bunch of guys, and they say, what's your valuation? It's all negotiated. So at that point, you can have cash flows, you can have all kinds of projections, and you can do like all kinds of net present value calculations if you want. But ultimately, it comes down to, how much risk do they want to take, and it becomes a negotiation. So the pre-money valuation at each one of these steps is a negotiation with your investors. So, and there are a ton of consultants that would love to charge you to calculate the net present value of your forecasted cash flows. But guess what? I can make a forecasted cash flow that shows you my pre-money valuation is $1 billion today. Isn't that great? This is where you hear the old adage about people will only, your company is worth what someone will pay for it, right? So at that point, you're having a negotiation to decide what your company is worth. Same thing that happens in the Series B. One thing that we didn't talk on the panel is that after Series A, the people who put the $5 million in, they're now on your team. So they're now on that side of it, and they're saying my $5 million is now worth $7.5 million, right? Because I have half of this. So my $5 million turned into $7.5 million. It's not liquid yet, but now the Series A guys are like out there going, hey, Series B guys, you need to put money in this thing at a higher valuation because they get to post that mark to market number. Okay, sorry, I got to keep going here because we got all. Anyways, okay. So let's just look at this example in terms of kind of the percentage ownership and how it works into the VCs. So they've invested a total of 15, is 5 plus 10. So they own 70% at this point. Now they want to get 3 to 5x return on that. So here's the math on how that works out. They want 60 to 90 million bucks, but they own 70% of the company. So the overall company has to be sold for 85 to 130 million bucks. So, and according to the sort of revenue multiples, you need to have roughly half of that in revenue if you're going to get a 2 times revenue multiple on exit. So we're kind of starting with the end. So this is just an example of like how much VC money and sort of a peer into what the financials need to look like in order to justify a $5 million and a $10 million investment. So now we're getting back to the point I made about the bar is rising, substantially. You've raised $15 million. You need to get $40 to $60 million in revenue. So, I mean, if you could see a way to do that, I mean, if you can really kind of see like, once I have $15 million, I can do all these things. I should be able to get sales traction and get to $40 to $60 million. That matches. And that means, VC might be the right route for me. I know we talked a lot about alternate forms of financing, but this is kind of a good example of a business where it would make sense to get equity-based financing. Okay. So now, if you ever hear the phrase, prepare a standard set of financials, I wanted to add this slide in here because I heard that a bunch and I was like, what the hell does that mean? It means these 3 things: balance sheet, income statement, and statement of cash flows, BS, IS, CF. And this is the standard form of communication across all boards of directors. So every board meeting I've run, you know, if the members of the board are technical, they might ask technical questions, but they all dive into the balance sheet, income statement, and cash flows. I want to see those every month. I want to see exactly where the business is and how it's operating. So this becomes the language of communication between what is the financial health of your business and where are you at. So the income statement is also known as a profit and loss, and a lot of times people throw those two back and forth. The balance sheet has assets and liabilities. Typically for a startup, I mean, you might have some patents, maybe some computers. That's about it. Maybe you've taken on some credit card. Maybe you've successfully moved your credit card debt onto the business's books, which would be great. And then cash flow, we won't talk too much about cash flow, but it's basically the income from operations, investing and financing. It's kind of more of something that you wouldn't worry about at this stage that I think most of you guys are at, but definitely you will eventually. So let's look at an income statement example for just a generic technology company. And this is all these percentages are based on the overall sales. I'm selling a product for $50. It cost me $20 to sell it. I've got a gross margin of $30 in that instance. And excuse me, my sales and marketing might be $15. And then I've got an R&D item for $5 and then a G&A, which I like that it says here, rent, accounting, HR, and IT. It's also management salaries too, but we don't like to talk about that in G&A. So, and then so you've got an operating profit here, and EBITDA stands for earnings before interest, tax, depreciation, and amortization. What that means is super simple earnings number like you're seeing here. I don't know why they give it that big long acronym, but it's like, what's your EBITDA? What's your EBITDA? I mean, what's my like simple operating profit? Is that what you're asking me for? Yes, that's what they're asking you for. So obviously you can tell from that acronym that there's interest, tax, depreciation, amortization that you can add on to all this stuff to make it a lot more complicated. But we want to start with just the basics. If investors ask you for a lot more detailed financials and you don't have any sales yet, they're probably the wrong investor. So the right investors at this stage are really just going to want to focus on the basics of the business and the basics of the income statement. So this example is a 4-year income statement. We're going to break it down and get into quarters, but I want to describe kind of what we're seeing here. This is the end goal of what we want to get to. And this example that I'm showing is a manufacturing company that has 3 models. And it's taken, the spreadsheet itself has multiple tabs and they roll into each other. The first model you launch in year 1, the second model you launch in year 2, and the third model you launch in year 3. And this is how the income statement is broken out in terms of what kind of sales you can get or revenue you can get from the first model, and the second model adds onto it. And then you've got the cost of goods sold that have been rolled up into this simple thing. So you've got a gross margin number here, and then you've got an engineering value there, marketing, G&A, just like the previous one, but with a little more detail. So let's see, let me see here. So this is what investors will look at. What's your top line revenue? How much money are you making? You know, that's what they really want to see first off. Then they want to look at the projections out 4 years. What's the actual percentage breakdown of kind of like, how are you running your business? How is the cost of goods sold coming in? Are you increasing a lot of expenses? You know, do you have a lot of overhead expenses that are coming in? Are there some gotchas into the mix? And then finally, they look at operating profit. And of course, for me, the most important thing is this point right here, where you go from, you know, -$3 million to -$2 million to positive. And that's the most glorious day ever when you reach positive cash flow, which means you can pay all your bills and you're not panicked about running on cash. Did you have a question? Not expenses. So cost of goods sold is an expense, but it's directly tied to the revenue item. So for example, if I'm making like a piece of hardware like this phone, the materials that go into it and the labor that specifically made this phone is a cost of goods sold. An expense is kind of across the entire company. So I was going to draw a picture, but maybe I could just do it with my hands. Like if I have a whole bunch of product lines and they all have expenses associated with each one, there's an engineering function over the top of them. There's a marketing function over the top of them. Those are expenses that kind of go across all the different segments. And then when I have individual product lines or even service lines, I can have a specific cost of goods sold associated with each one. that make sense? I mean, cost of goods sold they are an expense according to this definition. The expenses are the broader based firm-wide expenses. Make sense? Okay. And then finally, the gross margin at year 4 is really how a lot of investors want to evaluate, what can this company be? So we'll get into how you build this out, but the important thing that you're trying to send here, and the reason why building a financial projection is important, is because you are the strongest advocate of your own business. And if you're going to show an investor some forecasted financials that look terrible, they're going to be like, okay, goodbye. Like, I don't need to. So they're going to look at the forecasted financials and they want to hear from you why you think this business is going to be tremendous and the profitability is going to be tremendous in year 4. Like, what are all the things that go into it and what could it possibly be? Then, in their own mind, they're thinking like, how can I jam some more capital into this thing? How can we make this go faster? How can we, ramp it up? But this is what they want to see. And they know that you're going to be the most optimistic about it. So they know that you're probably going to have to, reduce down some of the hyper forecasts that you have in here, but they want to see the numbers that you put out. Okay. Now, same income statement. What should you look at? Top line revenue, 4 years, all the profits. And then if you're running the business, you want to be very familiar with year 1, right? Because we've said, you're the runners of the oxygen. So you got to make sure that year 1, year 2 tends to scale up. And then how does the percentages of each one of those things operate? And for me, I want to see, when are we going to get to break even? Like, that's the number that I keep looking at as we grow the business. Like, how far away from break even are we? How many more sales do we need to get? Maybe I'll get on the phone and do some sales myself just to get us to freaking closer to break even. Because that's just a great. I think in the video in the beginning, there was somebody who said, "Oh yeah, banks will give you money when you don't need it." Right? If you get to break even, you don't need the money. The banks are ready to give you money at that point. So, all of a sudden, a lot of financial options become open once you reach break even. So, okay. So financial projections show you kind of the rough black and white results of what your business can be, but you need some way of measuring your progress towards those results. So key performance indicators are good kind of ways of measuring the activity towards the end. This should say SaaS, right? Software as a service. So things like churn rate, which is like how many customers you've lost and how many are coming on again. Monthly recurring revenue, committed MRRs, customer acquisition cost. That's probably the most important that every investor I know in the SaaS space wants to know. What's your customer acquisition cost? Because they know if it's low, they can jam a lot more capital in and go a lot faster. I mean, the limits to growth for software as a service is pretty tremendous. So it's easy to get moving there. Okay. So let's talk about the business model. I think I made a comment in the first part. Oh, yes, you had a question? Let's use the microphone for the Zoomers. Does everybody have the spreadsheets, by the way? Oh, go ahead. Microphone working? No. Why don't you ask the question and I'll just repeat it for the Zoomers. Is it a long one? Yep.
For retention rates at the startup, since we don't have, for example, years of users, number of users, how can we estimate the?
So the question is about estimating retention rate for software as a service business? That's a great question. I have no idea. I mean, this is the thing. I'm trying to give you an overview of financials for just the generic technology company. So that's a very specific question about, something that doesn't have any traction yet, and you're trying to estimate the retention rate. It's an argument and a conversation with investors, right? Like that may be a way to filter out the investors. Like, hey, can you answer me this question? You can't. Maybe you're not a qualified investor to invest in this business, right? Like, you could use it that way. Other questions? No? Yes. So real quick, the customer acquisition cost, this is for a software as a service business. So it's the total cost of marketing and sales, and then how many customers I acquired in that period. So if I spent, you know, $500,000 and I acquired 10 million customers, then it's, well, whatever that is, 5 cents per customer. That is when I have a customer and they pay a certain monthly rate, and then what my average lifetime of keeping a customer on board is. So if after 12 months the average customer cancels the service, then I can really only count 12 months as the lifetime, you know, take the monthly rate that I get and then and calculate the lifetime value that I get out of them. And that's basically like, so what you end up playing is how much money can I spend to get a customer? And then when do I get to break even to pay back that marketing cost? And if my lifetime value is, you know, not very long and I spend a bunch of money to get them, I have a losing model. If that makes sense. Okay. All right, so the business model provides a superstructure for the financial plan, a blueprint of how your business will make money, and it's documented by the income statement. So typically the cash forecast is the income statement focused, like we want to know how much money you're going to make. And the question, I think I mentioned in the panel, when people say, what's your business model? They often just want to know, like, how do you make money? Or they might be just confused. The answer to that can be very simple. It's a software as a service business, or it's a freemium model or something, or we're selling products. You know, they may want to know like how you're distributing it, but typically I don't go into too deep of an answer when somebody just asks me that question, because they really just want to know, like, you know, how can we figure out what customers you have and what kind of traction you have. Okay, but let's look at tech company. Since we're in the world of technology, we can look at, these are old hardware, tech hardware companies. So what we see here is kind of a normalization of the revenue across Cisco Systems, EMC, Dell, and Medtronic, and then what their cost of goods sold are. And you can see Dell here has a pretty high cost of goods sold. So they're more in a commodity business, right? Cisco and EMC is more in a proprietary business. So it gives you kind of a better sense of how they operate. And they also spend very little of their overall revenue on R&D as compared to Cisco Systems and EMC. And then, of course, you know, these guys at Medtronics, the sales guys at Medtronics are making some pretty good money over here, or relative to their other business. So you have your overall expenses and then your resulting operating profit, and then how many employees there are. And then revenues per employee per year, which is an interesting metric that's not typically in your standard financials, but it's a good way to kind of do comparison between businesses. So how much revenue per employee are these bigger companies making? But you can see when you kind of analyze big technology hardware companies by percentages across this income statement, you can get a sense, sort of an intuitive sense for, you know, Dell is kind of a commodity hardware business. They've got a pretty high cost of goods sold. They're just buying stuff and reselling things. So let's look at a set of software businesses. Microsoft, pretty high or pretty low cost of goods sold relative to SAP and Oracle. But all of them have about the same R&D, and I guess it's the Oracle sales guys that are making money in this business. And then you can see the kind of similar revenue per employee. So then let's look at internet business models. I always love that phrase. Isn't everything an internet business these days? Apple, which isn't really an internet company, but we'll put it in here anyway. They have a fairly high cost of goods sold because of the hardware component into it. Interesting thing over here is Pandora has a pretty high cost of goods sold too, but Pandora, if you know, is just a music reseller. So they end up having to pay a lot of licensing fees for their music. So that ends up, you know, that hits the cost of goods sold. So you were asking about expenses. So like if my business is distributing songs and I'm not a creator of songs, I have to license them, and that's on a per song basis, right? So people are, or maybe it's on a bulk basis and I've got a bunch of monthly subscribers. You can see how the cost of goods sold works out. Zynga spends a lot of money on R&D here relative to their revenues. I'm not sure why there's no sales and marketing for Apple. They certainly spend plenty of money on marketing, but and then down here you can see the revenue per employee is like $2 million for Apple and $1 million for Google. This is old data, by the way. I'm sure it's probably like 5x this by now. Yeah, so that's just gives you kind of a way to sort of generally analyze different types of businesses to see how their financials operate. When you want to go and build a a tech model, you got to answer the question what your product is, the price the customer will pay, and then what your cost of goods sold will be on a unit cost basis with the manufacturing overhead. And then how are you selling it? How are you distributing it? It could impact your sales price. It'll definitely impact your sales and marketing and support expenses. And then just in terms of rule of thumb, your R&D should be about 10 to 20%. The G&A should be about 5 to 15%. And you should target an operating profit of 15 to 20%. These are just like good rules of thumb for a generic tech company, maybe not a medical device company. Yes, sir.
My experience that
Yep.
Would you just net that out in your revenue, or would you have to show a line, bad debt, showing that you're responsible?
Yeah. So the question is, where do we handle bad debt in our financials? Do you mean like debt that the company hasn't paid, or you have people that owe you money that aren't paying it? Okay. That's an advanced question. And we don't have that covered in here, but that's on the sales plan. So we'll go through a sales plan, and what we're going to show in sales plan is on a cash basis only. So it's like, I assume that if I sell a product, for $1 today, I get $1 in my bank account today. So what you're talking about is like I have deadbeat customers. I sell a product, I book the revenue, but my cash doesn't move. Like, what's going on? I've got all this booked revenue. Like, how come my cash isn't moving? Yeah, that's not in this presentation. We can talk afterwards though. Okay, so the first major decision is how you want to sell your product. Do you want to sell it direct, or do you want to sell it through a distributor? So here's an example of kind of direct sales force. Oh, wait a minute. $100 of revenue, cost you $40, your gross margin, and then kind of the sales and marketing expenses to get to that point. And if we compare that to kind of a distributor, so if you take the product and you hand it to a distributor, they'll take $20 off the top of that, and you'll book an $80 revenue, and then you'll have a cost of goods sold. In my experience, if you're starting where you guys are, where you don't have any customers, you only have one choice, which is you got to sell your product. So if you go and talk to distributors right now, the first question they're going to ask is, how many sales do you have? And if the answer is 0, they'll say, wow, what a nice day it is. Thanks for having coffee. Goodbye. Most distributors want to know, like, do you already have excited customers, and can I just jam this into my channel and just start selling the hell out of it? So you can use distributors, however, for great customer feedback. So they will definitely give you opinions about what should be changed and stuff. Is it worthwhile? They definitely have access to direct customers. So I would use them in a marketing capacity before I use them in a sales capacity. But this is how the numbers work out on the financial side of things, just in terms of kind of the overall income statement impact. Okay. Do not use business planning software. I mean, the spreadsheet that the Nuts and Bolts guys is fantastic. Like, it's really well done. Charlie did a great job of it. I'm not bragging about me. It was all Charlie's and maybe Joe's. I don't know. I would use that spreadsheet, and building sales projections from the bottom up is really, really, really important. So you want to show kind of individual sales that you're making on a monthly basis, because those are going to be questioned heavily by any investors. They're going to be like, how are you getting those sales? Who's doing the selling? How many leads do you have? When are you going to close these guys? That kind of stuff. You do not do it top down. However, I do recommend after you've built a sales, bottom up, that you do a sanity check with the bottom down. Like, after 5 years, if I'm showing sort of these really crazy projections, what percentage of the overall market is that? And I've seen far too many projections that show me making 500% of the market, in year 5, which of course is impossible, because how can you sell to a market, something that's bigger than the market? So, okay, how will you sell? How many salespeople? How long is the sales cycle? That's another really important one. And when you're first starting out, you don't really know how long the sales cycle is, so you need to get in customer conversations to find out, how much are you selling it for? If you're selling it for $599, it's probably not that long of a sales cycle. But if you're selling a $20 million piece of equipment, you got to get into budget cycles. You got to get in front of the board. You got to get approval from, the internal approval. It might be a year sales cycle to make that or more. But knowing what that is telegraphs a lot of confidence to the investors. So the more you know about, kind of how your sales operate, the more confidence an investor will have in you. And how much can you sell per month? Do not project best case, worst cases in a pitch. I do best case, worst cases all the time for internal documentation to kind of look and see like how sensitive are we to that break-even point? When is the company going to get to break even? And if there's a slight sensitivity that says, oh, we're not going to get to break even for not next year, but 10 years from now, I want to know about that. But that's not something that you put into something to present to investors. You want to put out a sales forecast and say, this is what the business can do, and then have them beat you up and ask a bunch of questions about the details of that. These are Charlie's rules of thumb, but I like them. So the exercise is focused on making it attractive to investors. And all these examples are for technology companies, and they may not apply to your business. What I just said about the revenue being too high in year 4 is a common mistake, and the profit margin too high in year 4 as well. So what I like to do is build out the forecasts and then go back and iterate on it and ask all the questions that I've heard a million times from tough investors about, like, how are you going to make those sales and how is that going to grow? And what happens if, other competitors come into the market and lower the price at year 2 or something, what's going to happen then? So there's a lot of good conversations that can come out of well-built financials. So staffing drives departmental expenses. If you guys are in R&D and technology, typically staffing is the most expensive piece of what you're building. And you can add and you can figure out kind of how the benefits add up and what the total expenses will be. Everything else is rent, utilities, and travel, unless you have to spend a ton of money on marketing, which would be a challenge. And then the sales staff is going to cost a lot per person, which is also why I recommend you do it yourself, because then you don't avoid that cost. And that's actually part of the I-Core program, that they sort of make sure that it's the founders of the technology that are doing the customer conversations. That's a really important piece. Okay.
Question.
Yes.
Percentage of your revenue should your marketing budget be in general? What range?
That's all over the map in terms of where you are in the cycle, what business you're in. Obviously, it can't be more than 100%, or I mean, I suppose it can be for a while. There's a lot of examples of people that, jam a whole bunch of money into marketing and then they just sort of let it play out. So it's really hard to say. What business are you in? Do you have any? Can you get more specific?
Just thinking in general.
I mean, I think some of these. What are some of the marketing budgets here? Like 23% there. Sales and G&A is 24% for Microsoft. So, for a software company, maybe it's sales G&A 26%, 29%. Dell's only 10%. Yeah, those are just some rules of thumb. Are they good? So sales and marketing here for Google is 12%, Facebook is 11%. Somewhere around there, it sounds like. But these are established businesses, right? This is not like trying to get things started. You may find yourself spending a ton of money on marketing to get things going. And that's also the reason why that, long-term value of a customer and the customer acquisition cost becomes critical, because it's like, are you spending more money than they're worth, right? Like, this is on a subscription basis, right, where people can go away. But if you're marketing like a product where you're trying to sell a product, then you can see how that could be a completely different equation. Yes, question?
That's more about the side. Before I heard that, I want to hear whether you confirm or not. Before I heard that, people say for tech business, sometimes investors only look at where people put a certain percentage of, like, for R&D, like enough projection for R&D.
Yeah, so the question is, what percentage of the income statement should the R&D be, and that investors have Yeah, so there's a lot of complexity to that question, but basically, so we look at these examples, right? So you can see kind of, Zynga has a 31% R&D budget. Why is that? And LinkedIn has a 23% of the overall revenue in R&D. What is that telling us about the business? It's telling us that Zynga and LinkedIn have a higher priority of R&D over their peers, right? So, and this is normalized to percentage of revenue. So it's not like they're spending more money on R&D than someone else. It's just more that it's more important. So depending on the phase that you're at, like your R&D budget when you first start is probably it's probably 10,000% of your revenue, or it's infinite if you have zero revenue, right? So it's kind of hard to do a comparison of first starting out. But what you're projecting to the investor if you have 0% R&D is that I don't care about R&D after year 2. Now that may make sense for your business, but if you have like a real heavy tech IP business and all of a sudden you're showing 0 on R&D, they're going to be like, thanks for the meeting. Boy, it's almost time for my tea time here, so I'm going to have to go. So hopefully that answers the question. Okay, where were we here? Okay, so let's see. Did I cover this? Rules of thumb, sales projections, 50 million to 100 million in year 5, revenue 150K to 350K, and revenue per salesperson $1 million to $3 million bucks. And if they don't hit the $1 million bucks, they hit the door. You know, it's either the steak knives, the Cadillac. Who knows what I'm talking about? Anybody? All right. Mandatory viewing. Okay. Happiness is positive cash flow. And knowing when to raise money is really good. I actually go one step further and I say, happiness is freedom. So what's your burn rate? That's a question you'll get all the time from investors. What's your burn rate? How much is burning per month, right? Which is like, how much is your cash going down every month? Monthly operating losses plus capital expenditures. What's your cash flow projection? Like, how much cash do you have in the bank? And when is that going to go to 0? And then we want to determine like, what's the total cash required in order to get this business to cash flow positive, and when does that happen? Okay. And then the question is, how much do you pay yourself? So this is a hard question, but I've been talking with a lot of friends. I came up with a new definition of minimum viable salary. So they don't want you to starve, but they want you to be hungry. So they don't want you to be distracted with consulting and doing other things to like pay the bills. But they don't want you to be fat and like, oh, hey, I'm getting this VC salary now. You know, I'm an AI ML engineer. I'm pulling down $1 million bucks. So, you know, I'm going to go to work next week sometime. Anyways, you get the point. Enough so you're not distracted by bills, but equity is where the big payoff is. So they want to make sure that the equity component that you're getting is really where the positive impact is. Questions? Okay, let's pause for questions here. Do we have a microphone that works? No? Any questions? No? Yes? I don't know, 250K? I don't know. I mean, it depends on how much you raise, right? If you raise 100K and you're taking a 200K salary, it's kind of like, okay, I don't think that makes sense. You know, if you're raising $300 million, maybe a $250,000 salary doesn't make sense, right? Like you have to balance it with the amount raised. But there's also a kind of a metric between if you're a founder and you have a huge piece of equity, that you don't also take a huge salary. So, you know, that's kind of where the minimum, and there's usually a negotiation around like, okay, we're going to put this much money in, but this salary you have for yourself, we're going to have to knock that down a little bit because this is unless you want to give us some of the equity that you've got. So I've had a lot of those conversations too. Other questions? Yes. Is it working now? Hey, all right.
Yes, since you mentioned like earlier the valuation for early stage startup, it's all about negotiation.
Yeah.
Do you have any like tips like for entrepreneurs to negotiate with the VCs?
Can you say that last part again?
Do you have any like tips, any like
Tips to
advice? Yeah,
negotiate.
for
Oh, yeah. Well, this is supposed to be about financial projections. I mean, it's a competitive marketplace, right? So if it's the only VC that's giving you an offer, then you do your best to negotiate with them. But if you have other offers and other opportunities, then you can signal that to them and let them know that, you know, I got a better deal somewhere else. You can look at, there's a ton of stuff in PitchBook. So who here is at MIT? Is everybody here at MIT? So whoever has an MIT login, you have access to PitchBook, which is like 20 grand a year, 50 grand a year or something to get it. So you can go like check it out. And in PitchBook, it says like everybody discloses kind of like the deals that they've done and what the value, not all the time, but a lot more than they used to. It like shows the valuation that things were raised at. So you can get an idea of the sector you're in, and you can get an idea of kind of the deals that were done maybe, 1 quarter ago or 2 quarters ago, and they'll give you the kind of the valuation. So that's a great kind of way to say, well, I see you've given me this $4 million valuation, but these guys got an $8 million valuation. Maybe I should go with their investors, right? Something like that.
Okay, thank you.
Yes, sir.
Mentioned in year 4.
Yes.
Show
Year 4.
Year 4, you really should have high expectations, high profits. Now, how do you define high profit? Everyone's definition is different. 10%, 20%, 30%. What are we talking?
As much as I possibly can get. No, it depends on the business, right? If you have a hardware business, your overall margin isn't going to be as high as a software business or like a software as a service business. So for that sector that you're talking about, there's going to be, like ranges of profit margin. So you're going to want to show as optimistic as you can. But I would, I would be realistic, to be honest. I mean, if you don't have a great projection with realistic numbers, then you should really rethink kind of, you don't want to pitch it to a VCs, right? You want to take it to a bank or somewhere else. Sort of a non-answer, sorry. All right, let's keep going since we got limited time here. Okay, so this is where we're going to get down and dirty. So hopefully you guys are ready to roll up your sleeves. This is the end result of what you get from the spreadsheet work. But so in the wonderful world of begin with the end in mind, I wanted to show you the end result here. So this is very similar to the one we were describing before. We have product revenue, but this time there's a little bit of a twist where you have support revenue. So this is kind of like I'm selling dishwashers and I want you guys to sign up for some support package, or you go to Best Buy and they're always trying to give you that support package on top of it. So I'm actually projecting out here product revenue, support revenue that goes along with that product, and then what the cost of goods sold is for that product and for the support costs, and then what all my engineering stuff is in here. So this is a 4-year profit and loss statement, and it's been rolled up from quarterly profit and loss statements that came to build in this stuff. When you get the spreadsheet, if you don't have it already, the way that it's designed is the red should be the only cells that you change. Everything else is calculated. And of course, magenta comes from another spreadsheet and blue goes to another spreadsheet. So if you look over it, luckily it looks complicated, but there's only a few red cells, and we'll show you those in a second. This is my chart that I added, which is incredibly simple, but all it is the same is the revenue line from here and the operating profit at the bottom here. And this is what I like to see, and this is what I like to showcase, because it very clearly shows me, how my sales have to go in order for me to be profitable. And then right there is the magic day when I reach break even. And then if you want to get even more nerdy, I can add up the area under this curve and say that's the cash that I need in order to get there, right? So this is the reason why I need to go to investors, because this is running negative cash flows for that long. But then as soon as I get enough sales, then I'll be able to ramp it up. So, and that you can do that calculation just by adding these two numbers together, right? 4.1 million and 2.1 million. So theoretically, I need $6.2 million to make this business go. But of course, the risk there is $6.2 million, according to this pro forma that I've just sort of made some assumptions and guesses about. So if I raise $6.2 million and I think I can do this exact plan, I'm a little bit foolish because I've left myself no wiggle room for mistakes. So when I look at this, I'm thinking, okay, you need to raise like $10 million, right? Like, yeah, 6.2 is what you're showing, but you're going to need a little bit of wiggle room there. Okay. And this is what I like to start with to kind of get a visual of what the business looks like, and then get into the detailed spreadsheets. Okay, so this is broken out by quarter. So we've got information from a sales plan brought in here. And luckily, all of these are calculated, so they actually came from a different sheet. This is the sheet that they came from, the sales tab in that spreadsheet that you're looking at. So these numbers are input, like how many do I think I'm going to sell in quarter 2 after I've built the model 1 of my product? How many am I going to sell in quarter 3? And what this shows, 20, 50, 100, 200, 300. Oops. I got to say, like, it feels pretty aggressive. Like, if I sell 20, in 3 months, and then I sell 50 in the next 3 months, I'm already on like a rapid ramp up here. Okay. And then what is the actual sales price I'm selling these things for? You can see here after 3 quarters, I've dropped the sales price down to $7,500 here. And then the second model that comes out has a slight increase in price of $12,000. And that's it. Oh, actually, and then down here, I've got the support base. What is my retention of support customers? 75%. That means like 25% of my customers cancel their support plan after a quarter. And then what is my support revenue, which is just calculated as 15% of the overall product revenue. Excuse me. So these red items are the only things that you need to enter if you want to use the spreadsheet for a hardware sales product, and everything else is calculated from that. Okay, and then you can't just do sales, you have to actually calculate cost of goods sold. So up here we have already have the units that have been sold, but then I'm building out a manufacturing plan. So this gets into cost of goods sold versus expenses. So now you can see very specifically that in manufacturing, I have a VP of manufacturing, a supervisor, and a technician, and other administrative people. These people are like on the manufacturing line. They're actually building product that's going to be sold. That's the distinction between a cost of goods sold and an expense. So then I've got some variable costs here. I guess they're just wild guesses of $1,500. And then I've got a facilities cost here. So $5,000 a month is my rent. Per quarter is $15,000. And then I guess we're expanding here in year 2 to get a second location. Exciting, thrilling. I can tell you guys are so excited about spreadsheets. Yes, question.
Factor in the COGS for a software company?
For a software company, the typical COGS are typically all of the expenses associated with distributing your software. So if it's internet based, you've got server costs, and you've got support of that server, and you've got whatever kind of internet expenses associated with that, right? In the old days, you used to have to package them in boxes and ship them out, so it's very clear what the distribution cost was. Yeah, that's why you see a lot higher margins in the software businesses, because there's like no distribution cost. Yes, Maine man. Maine man. You have Maine on your sweatshirt.
Oh, me.
So this is a specific use case, right? But say you have a business where, for example, like let's say eBay, where people are creating goods and selling goods.
Yeah.
What does basically the breakdown look like when you have like your own perpetuators of the network, right? Folks who are also building and selling within your platform.
Yeah. So man, you guys are good. These are hard questions. So the question is, if I have a marketplace, what's my cost of goods sold if people are creating their own storefront, they're selling their product through my marketplace. So there was actually a case, God, many years ago about revenue recognition and whether or not eBay could recognize the revenue that was flown through, that was going through their platform as revenue. And they said, no, you can't do that. It's basically just the percentage take that you get on everything, that's your revenue base, and that your cost of goods sold is whatever the support cost to deploy that is. So good question. Get my brain hurt. This is good. This is like 10-250 land. Okay, and then another tab in the spreadsheet is the staffing plan. So this is the engineering and marketing side of things, which goes into the expense column on that. It rolls up into the expense column. But this just shows you the number of people that you want to hire. And then later on, we have a salary tab that kind of sets salaries for those things. But how many programmers do you have, and how do they grow? What's not shown in here is where my recruiting expenses are, because if I'm going to hire that many programmers, I got to have some active recruiters out there, like hunting them down and interviewing them. Let's see, Marcom, other marketing. Okay. You can see all that stuff, and hopefully you can see it in your spreadsheet. And then a salary growth plan, a nice number to use is 15%, I believe is what Charlie recommends here, for the benefits add-on, and COLA, which is cost of living adjustment. I don't know why I guess COLA sounds cool, but that's basically like inflation every year. Like how much do your benefits have to go up every year in order to cover things? And then here are the salaries that you can enter in for each one of the people. Those are all in red, so they're input. And then it all flows out from there. Okay. Yes.
I noticed that there were any escalators built into that.
What's that?
I didn't see any escalators built into that. CTO.
Oh, no escalators? Yeah. Salary's flat. Is that what you're saying? Or are you saying they're,
Yeah, the salary's flat.
yeah. Yeah, well, you know, he's getting a lot of equity, okay? In fact, maybe I should reduce your salary because you're getting too much equity, buddy. Yeah, I mean, that's an enhancement you can add on to it. If every year you expect to give pay raises to everybody after your performance reviews and all that good classic stuff. Okay. Now we have departmental expenses. So salary and benefits and different supplies for the actual engineers to do the engineering work, and then marketing expenses. I like, you know, it used to be literature / PR, but now it's probably blog posts and social media influencers and stuff. You had a question over there?
How do you include equity in your expense? Or do you?
So yeah, good question. You don't include equity anywhere in any of these tables. So actually, they pop up in the balance sheet sometimes. This is all income statement. So this is all revenue. This is like operations, right? So the equity component and the capitalization of the company is a separate financial instrument. We'll go into that second. So let me keep going here. So we're running out of time here. Okay, non-salary expenses. You can all read through this. I don't know if there's any magic here. Yeah, no, it's nothing magic. Okay, so that rolls up into a quarterly P&L statement. And this is, I like to look at things monthly. So sometimes if you raise money from a VC and it's your first equity outside money into the business, they're going to want to have monthly board meetings because they're going to want to like watch things very carefully and make sure you're spending their money very carefully, even though it's your money after you've raised it and it's their equity. This shows quarterly, which kind of is a little more of a bigger, mature company. I like to know like exactly where things are on a monthly basis and you're on a weekly basis actually. And then you have board meetings every month. So you need to come up with a standard set of financials every month to show your cash burn rate and make sure nothing weird happened in the last month. That's typically how every board meeting I've had, sort of starting out from okay, we closed the round financing, yay, okay, get to work. Okay, first board meeting is like, okay, what the hell did you spend the money on? How could we gave you $4 million and now you're down to $3 million? What the hell? Oh, we didn't. You knew about all these other expenses that we had to pay off and things. So, anyways, I mean that wasn't me. That was a friend of mine. You know, he's real trouble. So, okay. So this is how it rolls up into the quarterly basis, and then you have CapEx, which is the capital expenditures on the bottom half, which is things like, you know, stuff that you buy, employee workstations, computers, that kind of stuff. But then cash flow, and I mentioned that I didn't really want to go into cash flow too much, but it's actually a pretty simple statement if you follow it. So it starts off with the money going in at the top, and then, or sorry, is done correctly? So how much money you put in, and then how much you took out, and then what you ended with. So what the ending balance was, and then the next year, let's see, it starts out with the same number. So you can see how the ending balance begins the next year, and you burn down cash, and then the ending balance begins the next year. So you can kind of follow the sort of water flow of kind of, here's this beginning cash balance, what do we spend money on, and then that ending cash balance becomes the beginning cash balance the next year. And it gives you a different view of kind of how things lay out. I had one investor who was like, wanted to see the cash flows every time. And I'm like, dude, it's like, just look at the expenses. This is what we spent money on. But he wanted to see it in a cash flow format because that is what he was used to. It was a very much, shall I say about this investor? Let's just say he owned a lot of Dunkin' Donuts. So when you're owning a bunch of Dunkin' Donuts, all you care about is the flow of cash through the whole stores and how it all works, because you kind of know how the business is going to run. There's no like, what do you think the R&D percentage is on Dunkin' Donuts, right? Like 0. It's like just jam, you know, in New England, we love our coffee. We love our dunk. So like, how many more can we get? Can our sales and marketing expense go up to jam more profit margin into these guys? So, okay. So that's the CapEx and cash flow real quick. So some suggestions on how to present your data. I definitely see financial plans as kind of an evolution. So I guess this is talking about evolution of your model. So as you kind of develop it first and iterate it on with some of your close advisors, and then get out to pitch investors and talk about your how the business is going to look, that's an important kind of iteration step. I would also I want to be very clear that when you get hard questions about your financials, that doesn't necessarily mean that you have a terrible business. It just means they either don't understand it, or they really want to understand what assumptions you made to kind of put into it, and then they want to push back on those assumptions. So I've met some incredibly financially savvy people, and they can crunch some financial, they can look at spreadsheets and say, what's your assumption for this? And you realize, that's the weakest part of my entire financial model. I've got all kinds of great arguments for everything else, but that one thing that I made an assumption about sort of drives the whole thing. And that's where you get into discussions and arguments and stuff. You want to show percentage next to quarterly and yearly columns. I definitely recommend showing pre-tax only. Tax and depreciation, that just gets complicated. Like how much interest did you earn on the money that you have sitting in the bank? Like, who cares about that, right? Like we want to just focus on the core business we have. I mean, yes, it's important because it's cash for you, but it's not important for financial projections. Some people want to, if you have multiple business lines, like a lot of these examples we're showing is very simple, like model 1, model 2, model 3. Some people like to take the G&A expenses if you have like individual business unit managers and sort of put them on the specific lines. So there's an operating unit that manufactures model 1 and another operating unit. So they want to spread that out. At this stage, we don't recommend doing that at all. It sometimes happens in bigger companies. Okay. So an executive summary will show annual P&L for 4 or 5 years, the data to justify the revenue projections, unit sales, average sales price, and when will you be profitable? When will you hit that magical break-even point? And then, of course, the total cash required. So I would say, for that example, I would say total cash required is 6.2 million, and I'm raising 10, right? So it's like, this is how much my financial projection shows that I need, but I'm raising more than that because I know that the projections are a future guess, or a educated future guess. And then for the full business plan, the presentation is annual P&L for 4 years, and then behind that, quarterly P&L for 4 years, and then staffing plan for 4 years and quarterly cash flows. So after you raise capital and you have kind of your first board meeting, I typically have, the board package has the executive summary on the top, and then drilling down as you open the page and go into the next ones, you get the full business plan of financials behind that. And a lot of the things they want to see, especially like in your first board meeting after you've raised capital, is like, what is your staffing plan? How are you going to grow this? What is your sales plan? How are you going to get this out the door? As you heard from in the panel, as soon as you raise capital, it's like, okay, great, we gave you the money. When are you going to exit? It's like, dude, it took me 6 months to talk to you freaking guys, and you've been dragging your feet, and now I finally have the money. I can finally breathe again and like build my product. And now you want to know like when we're going to exit? But so hopefully now you understand kind of where they're coming from and why some people are obnoxious like that. Okay. So questions on the financial plan, and then after that we're going to do equity plan as fast as we possibly can. No, we can do it as slow as you want. Questions? Good. All right, everything's crystal clear. I can tell by the glaze over your eyes that everything's wonderful. Yes, up front. No. That set is specific to the spreadsheet that you can download from the Nuts and Bolts website. And it's Charlie's spreadsheet that he built, and it's wonderfully done. Like I really like it. Primarily because of all these keys that he's got in there, and that you saw the things that were in red that I showed in the spreadsheet. Those are the only things you have to change, and everything else kind of comes. And you can look at the formulas that he's got in there too to see sort of how he's calculated things out. So that's not a standard. In fact, I would recommend you just make them in black and white when you go and print them out for the board or for the investor presentations. because red is usually a bad thing. When do we get to black here? We're in the red. Other questions? Yep.
That they talk about assumption. There's one key assumption somewhere in all these Excel sheets. And this key assumption is basically your sales pipeline, correct?
Is that a statement or a question?
It's kind of statement question.
Yeah, no, that is probably so. Drilling down on the reality of how you're going to sell this and who you're going to sell it to and what they've talked about is probably where I've spent 90% of my time with investors and with board members. Because at that point, it's like, okay, you know, who's going to buy this thing and how are we going to get this thing ramped up? Which kind of tells you why when I was sitting on this panel, I was like, Kickstarter is the greatest, because it's like, it shows you like people that want to buy your product, like before you even created it. Like that gets to, it boils down all this stuff about pitching and financial projections down to like the nitty gritty of, do you have something that someone will buy? And if that's true, then great. So yes, a lot of this assumptions and conversations around like, well, you saw in there, like, we're going to sell 20 units in quarter 2, and we're going to sell 50 units in quarter 3. And it's like, are you really? How are you going to do that? Who's going to sell those? Do you have a pipeline of contacts? Do you have qualified leads? If you guys were here yesterday, I listened to a little bit of, that was a great one, by the way. He's got a great sense of the sales. You know, do you have qualified leads? How many do you have? What's your conversion percentage? How many have you talked to? Did you talk to them yesterday? You know, like all those questions come in very strong because they want to see, do you have a plan to get to that 20 next quarter? And then there must be like 10,000 more behind them, because how are you going to get to 50 in the quarter after that? So that's a lot of the conversation you have, but you have to put them into a projection. So you show like, this is how my profit margin works, and this is how big it's going to be, et cetera, et cetera. So, good question. Thank you. Other questions? Otherwise, we'll split the pie. Okay. So equity distribution is probably the most challenging conversation that you have with all of your early stage founders, technical founders, everything else. And typically at the stage that you're at, where there's zero value on the table, talking about splitting a pie that has no value, but yet I want all of it, is a difficult conversation to have. So what I want to share with you is just some general guidance around how to have that conversation, or not necessarily how to have that conversation, but what others have done. How about that? And so you can point to this as what others have done as a way to kind of level set the conversation. So typically, the philosophy around equity distribution is to compensate for ownership of IP. You know, if somebody just wants to provide their IP, but they don't want to work at the company, you can provide some equity for that. How much committed they are, like, I've got a job over here, but I'll help you out a little bit. Or, you know, have you heard the joke about the ham and egg breakfast? You know, the chicken is participating and the pig is committed. Old joke. Old joke. I guess it's getting late. Okay. So the risk of the business, like what stage are you at? Do you have any money? I've tried to recruit some really talented people into a business that had zero money. And that's a really hard sell if they're like, well, you know, I'm working at Google and I'm pulling down a nice little 500K package. So what do you got for me? I'm like, well, I got nothing but a lot of equity. So that's a very real conversation, because if you look at your own business, and I know you all believe that your own business is fantastic, but there's really a lot of risk in it if there's no money in it. So it's really hard to convince someone to come over. So I would think about like, and then of course it's up to you. Like, do you want to do all that work, or do you really need someone else to do all that work? In which case you need to fork over a lot of equity to get them to kind of jump into the early stage business you're in. And then sacrifice kind of goes along with that. The work that that is going to be contributed is greater than the work that's already been completed. I hate to say it, but that's the truth. A lot of people are like, hey, it was my idea that went into this thing. It's like, well, you know what? What's the old saying about 99% inspiration? No, 1% inspiration, 99% perspiration. So it's like, okay, you may have an idea and you may have helped contribute to it, but you're going to get like a small piece of pie, and the rest of us that are rolling up our sleeves and working our asses off and taking big risks are going to get the lion's share of the equity compensation. So it's difficult, but very important to maintain internal equity. And the the metric that's really hard, especially for nerdy engineers, is everyone has to be feel like they've been treated fairly. So if someone feels like someone else is getting more and they're not putting in their fair share, I mean, some of that is a management issue where you have to make sure everybody gets together and make sure that everything's cool and everyone's being productive. But if you sense that that's wrong as the CEO, then you have to make an adjustment for that. Because, you know, and if you just sort of see how things progress, it's like, oh, this person got a lot of equity and they're not doing jack, and this person got no equity and they're working their ass off. Like, we need to make an, you know, you don't necessarily have to strip things from them. You can have a conversation with them to beat them up to make them work harder, but you should probably add more equity to the person who's been working harder. So generally speaking, when you get a stock grant, if it's restricted stock or a stock option, they always vest sort of standard for 4 years. And typically there's a cliff vesting. So you have to be employed for 6 months in a new position, and you get 0 equity for the first 6 months. And then after 6 months, you get, you know, like a certain amount that you vest in. And then it's sort of, sometimes they vest monthly after that up to the full 4 years. So you're granted a whole bunch of equity, but you don't actually have access to it. And certainly if it's a stock option, you can't really do anything with it anyway. You could probably convert it into stock, but you can't do anything with the stock because it's privately held. So yeah, so everyone should vest because not everyone will stay. The companies I've run in the past have been, after you leave, you have 30 days to exercise your options. So that means you can buy the stock. You know, you have to fork over cash in order to buy the stock and exercise the option in a private company, which of course no one ever did, because they're like, well, let's see, you know, I'm going to leave now and I have no idea what the future prospects of this company are. I have no control over what it could be. So no way do I want to, you know, buy the stock in the company. Any questions on that? Okay, good. So employee specifics. This is after 2 rounds of financing. So this is kind of like a well-established business at this point. The CEO has 5%, the VP has roughly 1 to 2.5%, senior managers have roughly 0.25%, and senior industrial contributor or independent contributors have about 0.1%. The founding management, so if you're a founding CEO, is typically 2 to 3x that, and founding employees might be 5 to 10x of their relative positions. This is kind of weird because it's after 2 rounds of financing, so you've already kind of been beaten up by the dilution of the venture rounds in all of this. So let's walk through some examples of how an equity distribution would work. Let's see. Wait, why is this? Okay. So can you see that? Not really. Hopefully you guys all have access to the slides here. Okay. So here is an example at company founding where I start out with 4 million shares and I've distributed them, you know, 2 million shares to the CEO, 1 million share to the who is this? The CTO? Does that say CTO? Yeah, CTO or CFO. And 1 million shares to VP sales. Now,
this is the template that's also downloaded.
Yeah, so you should have this exact, I think the exact numbers in the template if you want to download them. But my question for you guys is, what is the value of the business at this stage? Anybody want to take a guess? 0? Yeah, so we're going to argue over what percentage of the pie I get for a 0 value business. Well, and if you argue, it's because you believe that it can be worth something, right? You believe in the future of it, right? Okay, so it turns out in this example that you know, well, so then we actually hire in some early employees. So these guys are coming into a business that has no money, no cash, and we're going to give them, you know, a VP of R&D gets 250,000 shares or 5% of the overall equity. And you can see how this works, where we are adding shares to the overall. So it goes from 4 million shares to 4.5 million shares. And then you can see how the dilution sort of falls down. So the CEO went from 50% to 44%, 25% to 22%. So now we have all these great people and they're all equity compensated because nobody's getting a salary at all. And we managed to land $500,000 in angel financing. Well, that $500,000, we have an agreement, or we negotiate, to your question about what's the pre-money valuation, that the pre-money valuation is $4 million $4.5 million for my 4 million shares. So now the actual number of, well, this is kind of weird, shares and dollar value are getting mixed together here. I think this is $1 per share for all of these. So I add another $500,000 of capital, it dilutes everybody else down, and then you get a total of 5 million shares at this point. And that dilution took the CEO from 50% to 40%, or, the early share, 44% to 50 to 40%. So you can kind of see how that works out. And then we raise another round of capital, but this time it's $5 million at a $5 million pre-money valuation. So, I mean, the way that works is right now there's 6.6 million shares, I think, up here. So I just have to add another 6.6 million shares. And I need to certify those shares and add those to the overall amount of shares in the company in order to issue them to the investors. And then what you get is whatever this is, 13.2 million shares, and it's worth, let's see, what is the post-money valuation here? Nobody? $10 million. Okay. And then after so this is after 2 rounds of capital, we said that the CEO would be getting 5%, but in this case, the CEO was a founder, right? It was early on, he already had the 50% of the shares, so you can see how it dilutes down to 9.1%. So I think we said like 5%, but if they're founding employees, they typically get 2 to 3x that, but that's kind of how it works out. So, but at this point, you've raised what, $15 million in total capital. So hopefully you're going to, get $40 to $60 million in sales, kind of like we said in the beginning. You like that throwback? Huh? Okay. All right. Last slide. Look at that. 8:57. Perfect timing. Okay. So summary. Well, you've got all this stuff. You know all this stuff. Any questions? That's the last slide. Woohoo! Yes. Thank you. Is it arbitrary, the number of shares you select? Somewhat, but I'm sure my lawyer friend over here is going to be like, oh, geez, you don't know what you're talking about, Steve.
Yeah. Well, it costs you to get shares. You have to pay something depending on the state.
But how much though? It's like,
well, in Delaware, it could be a lot. Yeah. There's a whole bunch of things. That's something to discuss with your lawyer when the time comes. One of the things you want to think about is if you issue a lot of shares, and then let's say you get ready to go public, and the investment bankers come in and say, well, we've got to get the price we got to do some changing to get the price right. Sometimes they'll do a reverse split. So I had 1,000 shares, or 10,000 shares, and now you're telling me I've got 5,000 shares? That's a big internal issue with employees to explain. Why am I getting fewer shares? Well, because the company, you do the math, it works out,
Right. You're still getting the same amount of dollars, believe me,
Right.
but I'm getting half my shares. What's happening?
Yeah, so that's something as you get further along, you'll talk about. This template is really to help you think through, if you're going to have headcount and you're going to have to give out equity, how fast you're going to bring them on, how much you're going to give. Does it sort of work? Go back, rethink it. It's not a one and done. This is a sort of a.
Is there a rule of thumb for like if you're just starting out, like how many shares you should sort of start with? Like this example shows 4 million shares just to start with. Is that going to? Delaware gives you 10 million for free? Okay. $100 for 10 million.
Right, until you then file your annual report and realize, yeah.
Talk to your lawyer.
It's a
We don't
longer
know.
discussion. Good.
Question.
Thought about the INC model,
Yeah.
but yeah, for a biotech that was an LLC model.
Yeah.
And that works with profit sharing units, which I found really interesting.
For a biotech?
Yeah.
Long discussion. Typically, venture investors don't want to invest in an LLC, even though, because the attributes flow through. And if some of their limited partners are foreign entities, then you get US tax. There's a whole bunch of taxation things.
So I can name the company Nimbus Therapeutics, if you want to look it up, because
Okay.
they did extremely well last year with their
Okay.
asset being bought by Takeda.
And they do have investors like venture groups.
Yeah, there's a real argument why it makes more sense, but traditionally the VCs don't want an LLC. And partly for the flowing through to the limited partners. So maybe they've been enlightened over the years. I've had this discussion a lot, and they say, no, I understand. It's really good if we did this, but, and then it's inertia. So I'll take a look at that.
Yeah, thank you.
Yeah, so in my experience, I've seen people convert from LLC to a C Corp in order to get venture capital for exactly that reason, because the VCs have an agreement with their limited partners and it says like no flow through. So it's like, we're going to make this investment, but you got to be a C Corp. Okay, that's an easy change.
Right, there's some videos on capital structure and the materials, but a limited liability company, there's no taxation at the company level. All of it flows through to the shareholders. So they have to take it on their own returns. And it doesn't mean the cash flows through, it means attributes flow. Yeah.
Other questions? It's only 9 o'clock. We can go till 3 a.m. That's my bedtime.
I'm sure there'll be individual questions for you offline. So can we give a round of applause for Steve? Thank you. And tomorrow you'll do your second session of.
Oh, that's right. I forgot to pump the SBIR. Tomorrow, 3 to 5 p.m. 4270 is the advanced second version of my SBIR talk. We're going to talk about advanced topics on how to apply for multiple SBIRs, how to stack them together, how to do some gap management, how to find external funding for them, all kinds of fun stuff. Join us.